Chapter 19 and 20 examples for accounting 323 or cost accounting. In chapters 19 and 20, we talk about different performance evaluation models and company valuation models that we use to determine how well a company is performing or a division is performing. In this example, we have 3 different divisions and we're evaluating what their return on investment is or their ROI. Return on investment can also be broken down using the DuPont model into return on sales and asset turnover. The DuPont model is return on sales times asset turnover equals return on investment. We also have 4 different asset cost classifications here. The 4 different asset valuation costs show what kind of effect the asset value has on a division's return on investment. So the net book value is the historic cost minus accumulated depreciation. Gross book value is the historic cost. Replacement cost is the current market value of our assets, and the liquidation value is what our physical assets would sell for today if we were to go out of business. So the liquidation value removes any intangible assets and only looks at physical assets that we can sell. One of the reasons that we look at these 4 different valuation methods is because if we have divisions that have older assets or older historic costs than others, that can give them a better return on investment versus a company or a division that just has a new building this year at current market rates versus a division that's been open for 10 to 15 years and had asset purchases at 10 to 15 year ago costs. We also have different locations. So we know that assets in New York cost different than assets in Des Moines. So if we're trying to evaluate a division in New York versus a division in Des Moines, those different asset valuations can give very different return on investment calculations. So we're going to calculate the return on sales, asset turnover, return on investment. Return on sales is the operating income divided by sales. So we would take the operating income of each division divided by their sales. Asset turnover is sales divided by the net book value of assets. So we take the division's sales and divide it by the net book value of their assets. And we would do this calculation for each level of assets. So if we lock that sales column, then we can carry those formulas over. And for return on investment, we take the operating income divided by the investment. So we'll start with the net book value column. Of course, if we lock that operating income cell, we can carry our formula across. We can then use these figures to calculate the division performance and decide whether or not the managers of those divisions are going to get bonuses. In this example, we're going to calculate return on investment, residual income, and economic value added income. So we're going to look at first the return on investment. So return on investment is operating income divided by average total assets. We're then going to look at the residual income. What the residual income for a division is the amount of income that is left over after meeting the minimum required rate of return for each division. So this will be a positive number if we're already meeting the required rate of return, and will be a negative number if we're not meeting the required rate of return. This is our operating income minus the minimum desired rate of return times the average total assets. So we take our operating income minus average assets times the minimum desired rate of return. Operating income times minus average assets times minimum rate of return. What economic value added looks at is what is the intangible asset effect? What is the effect? So we change our sales amount, we adjust that based on accounting differences in costing, in inventory evaluation. We also try to account for intangible asset calculations. There are a lot of things that go into economic value added amounts. For this calculation, we're just looking at the effect on net income of intangibles. So what the calculation is then is operating income plus the intangibles effect on income minus the total average assets, so the sum of assets plus intangibles times the cost of capital. So we take the operating income plus the intangibles effect on income minus the sum of our average total assets and value of intangibles times So the greater the amount of intangibles a division has, the greater their economic value added income is going to be.